Hi students, welcome to the video on financial accounting at your fingertips. In this video, we will focus on reconstitution of partnership due to admission or retirement or death of a partner. So already we have taken 6 videos on partnership. That means we have covered the final accounts of partnership are with all the adjustments. In this video, glimpse of the topic is meaning of reconstitution of a partnership are, then different forms of reconstitution, then at the time of admission of partner, what are the two rights of a new partner admitted in partnership are. One right is the right to share in the assets of the partnership. That means when the new partner is admitted into partner's business, he will share the assets of the business. He will get benefit out of the appreciation in the value of assets. That's why he brings capital for his share to the partnership. Then the right to share in the profits of the business. That means the business, suppose the business is already in existence since it started since suppose 15 or 20 years back. Within the 20 years, the partnership firm gained fame and popularity so that business multiplied. So when a new partner is admitted to that partnership firm, he will get benefit of the profits of the partnership firm. That's why he has to bring a certain amount for his share of profit in terms of goodwill or premium. He will enjoy, because he brings premium, to enjoy the fruits of another person's effort. Means previously, suppose existing partner, they took initiative, efforts to develop the partnership firm, and the result, the partnership firm is now in a profitable venture. Then points require attention at the time of admission of new partner. When a new partner is admitted into partnership firm, these are the points to be covered. First, calculation of new profits and ratio. Then, revaluation of assets and liability, treatment of premium or goodwill, adjustments of undistributed profit and losses, then adjustment of capital to bring these in proportion to profit sharing ratio. So, reconstitution of a partnership arises when either a new partner is admitted into partnership business or a partner retires out of agreement among the partners in the partnership firm or on the death of a partner in the partnership firm. Then partnership firm will be reconstituted. That means their profit ratio will be calculated, asset will be revalued, any accrued loss will be adjusted from capital. Like this it will be done, and there will be valuation of goodwill, and he will take his share. Suppose admission of partner, he will bring his share of goodwill. Suppose the retired partner, he will take his share of goodwill along with on his retirement, and suppose death of partner, the legal heir of the deceased partner will get this share of goodwill. So all of you know, goodwill is the valuation of the reputation of firm in respect of profits expected in future over and above the normal rate of profits. Suppose normal rate of profit is suppose 12%. If one will get, or the partner will get suppose 20% profit, then that 8%, for 8% he has to pay the share of goodwill. So it is the extra value attaching to a prospective business beyond intrinsic worth of new assets. So how new profits ratio will be calculated. Suppose it is given Mohan and Ramesh are sharing profits and losses in the ratio of 2:3. They admitted Harish for 1/4 share in future profit. Calculate new profit sharing ratio. When Harish is admitted in new partner's firm, his share of goodwill, his share of profit you have to calculate first. So, new partner is Harish. Harish share of profits is equal to 1/4. So total profit is always 1. Total profit is equal to 1. So share of other partners. Share of other partners or existing partners. Share of old partners. That is existing partner or old partners is equal to 1 minus 1/4. That is 3/4. Then they admitted Harish for 1/4 share in the profit, calculate new profit ratio. So the Mohan and Ramesh profit sharing ratio of Mohan and Ramesh, profit sharing ratio of Mohan and Ramesh is given 2:3. So new profit share ratio of Mohan. Mohan is getting 2/5. So 2/5 of 3/4. So remaining profit, the new partner has taken 1/4 profit, 1/4 share, the remaining is 3/4 and 3/4. 2/5 will be taken by Mohan. That is new profit ratio is 6/20. Then Ramesh 3/5 into 3/4. That is 9/20. Then new partner, that is Harish, is 1/4. Suppose it is 1/4, we multiply 5 in both numerator and denominator to make the denominator 20. So 5/20. So new profit sharing ratio of 3 partners. New profit sharing ratio of 3 partners is equal to 6:9:5. That means 6/20 is to 9/20 is to 5/20. So it is 6:9:5. This is the answer. Then another question or illustration is given that we will solve. X and Y are partners sharing profit losses in the ratio of or in the proportion of 7:5. That means X is getting 7/12 and Y is getting 5/12 share of profit. They agree to admit Z into partnership, who is to get 1/6 share in the profit. He acquired this share as 1/24 from X and 1/8 from Y. So first, old profit sharing ratio of X and Y is equal to, this is already done, then 2 started, 7:5. So X, old profit sharing ratio or old share, is equal to 7/12. Y's old share is equal to 5/12. And new partner Z is admitted with 1/6 share. Z's share is 1/6, 1/6. Then he gets, so X share, X new profit share, new profit, or X new, X share of new profit, X share of new profit is equal to, X was getting 7/12 and he has given that new partner has taken 1/24 from X minus 1/24. So LCM is 24, then 14 minus 1, 13/24. And Y is new profit sharing ratio, or Y is share of new profit. Share of new profit. That was 5/12. 5/12 minus, he has given 1/8 minus 1/8. So LCM is 24. Then 10 minus 3, 7. 7/24. So new profit sharing ratio of XYZ. New profit sharing ratio of X, Y and Z is equal to, so X is getting 13/24 and Y is getting 7/24, a new partner is getting 1/6, that is 4/24. So the new profit ratio is 13:7:4. This is the answer. Then another is there. Three. A, B share profits and losses in the ratio of 7:3. Say A's old share is equal to 7/10 and B's old share or existing share is equal to 3/10. C was admitted to partner. A surrender 1/7 of his share. So on admission of C into partnership firm, A surrenders 1/7 of his share, his old share, that is equal to, or that is 7/10 into 1/7. So it is 1/10. Here surrender 1/10. So S new profit sharing, S share of new profit. That means after surrendering 1/10, his new profit is equal to 7/10 minus 1/10, existing in last 6/10. Similarly, B surrenders 1/3, surrenders 1/3 of his profits. So he was getting 3/10. So 3/10 into 1/3, 1/3. 1/3 of his share. So this is 1/10. B is also surrendering 1/10. So B's share of new profit is equal to 3/10 minus 1/10 is equal to 2/10. So A is giving 1 by 10, B is giving 1 by 10. So C's share of profits. She is admitted his share of profit. He is getting 1/10 from A, 1/10 from B. So total is 2 by 10. He is getting 2 by 10. So new profit sharing ratio is equal to new profit sharing ratio of A, B and C. So A is 6 by 10 and B is 2 by 10 and C is 2 by 10. It is 6 is to 2 is to 2, or we can write 3 is to 1 is to 1. This is new profit. X, Y are partners having profit losses in the ratio of 3 is to 1. They agree to admit Z into partnership firm. Z gets 1/4 share of future profit which is acquired in the ratio of 2 is to 1 from X and Y. Okay. So this is another problem. Unless and until you acquire knowledge how to calculate the new profit ratio, sacrificing ratio, or gaining ratio, revaluation of assets and liabilities, adjustment of undistributed profit, you cannot solve problems related to admission, retirement, death of partners in a partnership firm. So you have to acquire the knowledge, full knowledge of how to calculate the new profit ratio, sacrificing ratio. Here X and Y are partners. X and is to Y, old sharing ratio are 3 is to 1. So X share of old profits, share of old profit is 3 by 4 and Y's share of old profit is equal to 1 by 4. Then Z is given 1/4 share. Z's share of profits is equal to 1/4. So X surrenders, because it is given, they have surrender ratio of 2 is to 1. 2 is to 1. X surrenders 1/4, 2 is to 1 and 2 by 3 into 2 by 3. That is 2 by 12. Y surrenders, then Y was getting 1/4 into 2 is to 1, 1/4 into 1 by 3. That is 1 by 12. So X share of new profits. X share of new profit. This is X surrender or X sacrifice you can write. You can write X sacrifice. And Y sacrifice. So X share of new profit is now, previously was getting 3 by 4, he has surrendered 2 by 12, so remaining is 12, 9 minus 2, that is 7 by 12. 7 by 12. Y's share of new profits. Y's share of new profits is equal to 1/4 minus 1/12. So it is 12, 3 minus 1, that is 2/12. Z share is 1/4. Here it is given X and Y are partners having profit losses in the 3 is to 1. So X share of old profit 3/4, Y is 1/4. They agree to admit Z into partner firm. Z given 1 per share of future profit, so for 1 per share, Z is getting 1 per share. So for 1 per share is getting 2/3 from, that is 2/12, and Y 1/12. So this is 3/12 or 1/4. So X share of new profit, X was getting 3/4. Now he has given 2/12 to, he sacrifices 2/12 to Z. So LCM is 12, then 9 minus 2, 7/12. Here LCM is X share of new profit, he was getting 1/4. He has sacrificed 1/12, so it is 12, then 3 minus 1, 2/12. Then Z's share of new profit is given. Z share of profit is the new partner. So he is getting 1/4, that is 3/12. So new profit sharing ratio, new profit sharing ratio of X is to Y is to Z is equal to 7/12, D is to 2/12 is to 3/12, or we can write 7 is to 2 is to 3. This is the fourth problem. Then fifth problem. And fifth problem is given sacrificing ratio. So for getting sacrificing ratio, for old ratio and new ratio is given. So from new ratio, old ratio, the old partners, new ratio will be deducted, then we will get the old partners sacrifice. Then if the old partner sacrifice is given, we will total the sacrifice and that will go to new partner. Here it is given, A and B partners having profits in the ratio of 6:4. So A is to B, that is 6:4. So A's share of old profits, share of, it is A's old profit share of old profit is 6/10, and B's share of old profit 4/10. Then here they agree to admit, C is admitted as a new partner. The new profit ratio is given. New profit sharing ratio of A, B, C, of A is to B is to C is equal to 10 is to 6 is to 4. So A's share of new profits, A share of new profit is equal to 10/20. B's share of new profits is equal to 6/20, and C's share of new profit is given, that is 4/20. So we have to calculate the sacrifice ratio of A and B. A's sacrifice is equal to old ratio minus new ratio. So A's old ratio was 6/10. Now he is getting 10/20. So it is LCM is 20, 12 minus 10, 2/20. That is 1/10. And B's sacrifice is equal to old ratio minus new ratio. Old ratio was A से sacrifice, old ratio was 10 by 6 by 10, now it's getting 10 by 20, correct. It is LCM 20, then 12 minus 10, 2 by 20, 1 by 10. B sacrifice is 4 by, originally he was getting 4 by 10, now he is getting 6 by 20. So LCM is 20, that is 8 minus 6, 2 by 20 or 1 by 10. So sacrificing ratio of A and B. Sacrificing ratio of A and B is equal to, here it is 1 by 10 is to 1 by 10, that is 1 is to 1. This is 1. Then we will discuss about revaluation of asset. All of you know the assets and liability of any organization is based on the original cost. Original cost of assets and liability, and fixed assets subject to depreciation, accordingly the value will be arrived. But when a new partner is admitted into the partnership firm, the old partner wants to take any benefits due to appreciation of assets and any loss due to depreciation of asset and any profits due to appreciation of liability, then depreciation of liability and any loss due to appreciation of liability. For that reason, they will take the share of their business. That means that is known as revaluation of assets and liability or adjusted profit and loss account. Revaluation account or profit loss adjustment account. So we will prepare a revaluation account or profit and loss adjustment account. So we will do like this. This is left hand side is debit side and right hand side is credit side. So we will write like this. This is debit side, this is credit side. Then particulars amount, then amount, then particulars amount. So all of you know, increase in assets should be debited, decrease in assets should be credited. Suppose there arises increase in the assets, should write asset account debited to revaluation account by assets account, that is increase in value. Then to assets account or decrease in value, to assets account or decrease in value. Then by liabilities account for decrease in liability, by liabilities account, that is decrease in value of liability. If there is anything increase in the value, we write revaluation account debited to liabilities account, that is increase in the value of liability. Suppose one unrecorded asset is, suppose one asset is there, it is not recorded, now we will record it. So by unrecorded assets, so unrecorded asset are debited to revaluation account. Similarly, suppose there is unrecorded liability right to revaluation account debited to unrecorded liabilities. Now we will balance both the sides. Suppose right hand side is heavier. Suppose right hand side is heavier, then then the difference about will be put here as to profit on revaluation of assets transferred to capital account. Profit on revaluation of assets transferred to capital account of old partner, transferred to capital account of old partners in their profit sharing ratio. Partners in old profit sharing ratio. Old profit sharing ratio. Suppose this total is, suppose this is 5 lakh and this is suppose 3 lakh. 2 lakh is the, suppose total 2 lakh, 3 lakhs. Then so profit is suppose 2 lakh. That profit will be transferred to either capital account or a current account of old partner. All of you know, if it is fixed capital method, then it will be transferred to current account. If it is fluctuating capital method, it will transfer to current account of old partners in their old profit ratio. Suppose old profit is 2:3, 2 by 5th of 2 lakh, that is 80,000 will be credited to S capital or S current account, and 1,20,000 credited to B's current account. This is all about the revaluation of the assets. So you should know what are the factors affecting the valuation of goodwill. Goodwill you know, then valuation of goodwill is affected by if there is favorable location or site. Suppose the old business is in a better position or better place. That's why it is acquiring benefits from the very beginning. Now the benefit is multiplied. That's why when a new partner is admitted, he has to bring his share of goodwill to compensate the loss of old partners. Then time factor. Suppose business is very old, then definitely it acquires more goodwill and it is having reputation in the market and it earns maximum profit due to its long duration in the line. Then nature of business. Suppose nature of business is safety, that is essential, normal, it will earn profit, there is no risk, then definitely the value of goodwill will be more high. Then capital requirement. Suppose capital requirement is more, then value of goodwill less. Suppose capital requirement is less, then definitely the value of goodwill will be more. And depends on the efficiency of management. Suppose managements are very efficient, then effectively they are running their partnership firm, then definitely they will charge a good amount of share of goodwill in terms of premium from new partner. Then possibility of competition. Suppose there is less possibility of competition, it is having monopoly in the market, it will have profit, so the goodwill will be more. And there are miscellaneous factors like management, money market condition, then rules of the country and government attitude, rising, declining, the dependence method, like this. So, valuation of goodwill. We will go to valuation of goodwill. There are 3 methods of valuation of goodwill in the partnership firm. 3 methods of valuation of goodwill. Methods of valuation of goodwill. Methods of valuation of goodwill. First is average profit method. First is average profit method. Under average profit method, the net profit of past, suppose 4-5 year what is given will be added. Suppose one is 42,000, suppose 3 years profit is given. Then suppose 46,000, then suppose 50,000. So average will total will get the average. So average is, that is 1,38,000, 42,000 plus 46 plus 450, so it is 88 plus 1,38,000. So by 3. Suppose it is 1,39,000. Yes. So average is 46,000. Suppose goodwill is equal to 2 years average profit. 2 years average profit means 2 into 46,000. So value of goodwill is 96,000. So suppose new partner share of goodwill is new partner share of profit. New partners share of profits. Share of profit is equal to suppose 1/6. So his share of goodwill is equal to 96,000 into 1/6. So it is 60. Here to bring 16,000 as share of goodwill. Suppose then this is average profit method. Under super profit method, suppose here super profit method. Under super profit method, we have to arrive average profits or average adjusted profit, whatever that may be, average profits minus normal profits. This is super profit, normal profit, and goodwill is suppose 2-3 years super profit will multiply. Suppose average profit here was 46,000, and normal profit, suppose there is investment 4 lakhs in the business and return is 10%, it is 40,000. So goodwill is 6,000. That is super profit 6,000. Suppose goodwill is 5 years super profit. 5 years super profit. So goodwill is 30,000. Suppose Z is getting 1/6. So he will bring 1/6 into 30,000. That is 5,000. This is all. Then capitalization value method. Goodwill valued on capitalization method. So under capitalization method, suppose it is given a firm earns 66,000 as its annual profit. A firm earns rupees 66,000 as its annual profit. As its annual profit. A rate of normal profit 10%. Rate of normal profit. Rate of normal profit 10%. Profit 10%. Then it is given assets of the firm that is assets of farm. 7 lakh is given. Liability of a farm is given, it is 7 lakh. Then liabilities of farm, it is given of farm, it is given suppose 2 lakhs. So we have to calculate the capitalization value method. So capitalization of profits is equal to normal profit, that is average profit. Farm had 66,000, so 66,000 divided by 10%, so it is 66,000 into 100 by 10, so it is 6,60,000. Then less net value of assets. Net assets value is assets 7 lakh minus liability 2 lakh, that is 5 lakh. So value of goodwill is 1,60,000. Value of goodwill is 1,60,000. Suppose new partner is getting 1/4, so here to bring 1/4 into 1,60,000, 40,000 as a share of goodwill to the partnership business. So one problem is given, we have to solve on revaluation. Solve problems on revaluation. Problems on revaluation. So it is given the balance sheet of Sujata and Suman, who share profits equally, are as follows. Capital Sujata 1 lakh, Suman 1 lakh 40, 2 lakh 40, creditor 34,000, bills payable 26,000, general reserve 60,000, so total 3 lakh 60. Land and building 60,000, plant and machinery 70,000, furniture 24,000, sundry 26,000, stock 40,000, cash 1 lakh 40. On 1st April 2022, Suresh joined the firm as a third partner for 1/5 share of future profit on the following terms and conditions. Goodwill is valued at 2 lakhs. Suresh to bring his share of goodwill in cash. Suresh to bring in 1 lakh as capital. A provision of 10% is to be created on sundry debtor. Land and building to be valued at 80,000. Stock and plant and machinery to be reduced by 20%. Draft journal entry to record the above arrangement and give the opening balance sheet of new firm. So first we will calculate or we will prepare revaluation account. This is revaluation account. So for revaluation accounts, we will do like this. This is revaluation account, revaluation or adjusted profit loss. It is otherwise known as adjusted profit loss. Revaluation account of Sujata and Suman. Sujata and Suman on, okay. We'll write here revaluation. Here a part provision of 10% create a sundry debtor. Sundry debtor, if we will keep provision, this is particulars, amount, then particulars, amount. The left hand side is debit side, right hand side credit side. So it is decrease in the value of asset to provision for revaluation to provision for doubtful debt. The amount is 10% of sundry debtor. Sundry debtor is 26,000. 10% means 2,600. Then land and building to be valued at 80,000. Land and building value was 60. Now it is 80. Appreciation 20,000. By land and building, there is appreciation to the extent of 20,000. Stock reduced by 2 stock reduced by 20%. So value of stock was 40,000. 20% means 8,000. Then plant and machinery reduced by 20% to plant and machinery account. The value was 70,000. 20% 14,000. This is 14,000. So share of goodwill is then cash. Okay. So this is all about revaluation. There is revaluation loss to the extent of 24,600. So there is loss of 4,600 by partners capital account. Partners capital account. The existing partners are Sujata and Suman. Sujata and Suman. So it is loss is 4,600. Their profit ratio is equally. So 2,300 each. 2,300, 2,300. That is 4,600. So total comes to 24,600. So revaluation is done. Then another capital account will be opened. Capital accounts. Capital accounts of 3 partners. So capital accounts of 3 partners. This is capital account. Then this is suppose Goodwill. This is 3 partners. 1, 3 partners. Three partners. So it is suppose particulars, then so debit, credit, particulars, then here Sujata, Suman, and new partner is Suresh. Sujata, Suman, Suresh. Then particulars, Sujata, Suman, Suresh. So first their old capital was 1 lakh, 1 lakh 40. By it is credit balance. Capital is credit balance. So write by balance carried down. Sujata 1 lakh. Then Suman 1 lakh 40,000. Suresh brings cash or goodwill. Cash account debited to Suresh by cash or bank. We can write cash or bank. So Suresh brought how much? He brings goodwill is valued at 2 lakh. Suresh to bring his share of goodwill. So 2 lakh. Suresh is getting 1/5. So 2 lakh into 1/5, that is 40,000. This is cash or bank towards goodwill or premium. Then by cash or bank towards capital. Cash or bank towards capital. That he brought 1 lakh. So he brought 1 lakh as his share of capital. Then there is loss. So in case of loss, we write to revaluation account or profit or adjusted account. Loss on revaluation, loss on revaluation. So 2300, then 2300. This is all. Then another is undistributed profit is there. General reserve 60,000. General reserve 60,000. So general reserve will be distributed. General reserve account debited to capital account by general reserve. They are getting equally, means 60,000 is there, so 30,000, 30,000. Now we will balance the capital account. So credit total is 1,30,000. Here also 1,40,000 plus 30, 1,70,000. Here it is 1,40,000. So we will calculate two balance carried down. This is two balance carried down. 2,300 will minus, so 1,27,700. 1,27,700. Then 1,67,700. Here 1,40,000. This is all about the closing capital of partners. So 1,30,000, 1,70,000, 1,40,000. Draw two parallel line to close the account. Now we will prepare the balance sheet. Most important is here balance sheet we have to prepare, it is given. Balance sheet, opening balance sheet. That will give the opening balance sheet of new firm. So opening balance sheet of new firm. Opening balance sheet of new firm. Opening balance sheet of new firm. Assets, liabilities. New firm. That is opening balance sheet of Sujata, Suman and Sujata, Messrs. Sujata, Suman and Suresh as on 1st April 2022. So this is liabilities. On the liability side, we will write first capital accounts. So we have already arrived the capital. That is Sujata's capital. Sujata's share is 1,27,700. Then Suman 1,67,700. Then new partner Suresh 1,40,000. So it is 4,35,400. Then creditors 34,000. Bills payable is given 26,000. Then assets, land and building, it is 60,000. There is appreciation 20,000, so 80,000. Land and building 80,000. Then plant and machinery 7,000 minus 14,000, that is 56,000. Plant and machinery 56,000. Furniture 24,000. Furniture 24,000. Then sundry debtors less provision. Sundry debtor was 26,000 less provision for bad debt 10%, that is 2,600. So it is 23,400. Then stock also 20% reduced, that is 40,000 minus 8,000, 32,000. Then cash or bank balance, that we have to calculate. So bank, we have to calculate one bank or cash account. So opening was there, to balance brought down, amount was 1,40,000. Then to new partners capital, that is to Suresh, that is 40,000 for the share of premium, then 1 lakh share of goodwill. So total comes to, by balance carried down, it is 2,80,000. So this is 2,80,000. So we total it. Here it is 400, then 4,95,400. Here also same 400. So 4,95,400. This is all about the preparation of balance sheet in the books of the new firm. Thank you for watching the video. Don't forget to like and share the video to all of your friends so that everybody will benefit. And please subscribe if not already subscribed.